Today, we open manuscripts written not in ink on parchment, but in steel on the very soul, for they concern how to achieve invincibility in the most ruthless battlefield, the financial market. We speak of fear, that invisible chain which binds a trader to false hope or paralyzing despair, destroying any strategy like a sandcastle under the tide. Searching with a scalpel in the chaos of price movements, we constantly strive for control over what is, by its very nature, absolutely uncontrollable. The wisdom of the Emperor Marcus Aurelius, who ruled a world while simultaneously ruling his internal empire, grants us the only tool capable of restoring dignity and tranquility. To combat this destructive state, apatheia is necessary, not in the modern sense of indifference, but as the Stoic liberation from destructive passions that distort judgment. This means reaching a state where neither the euphoria of profit nor the pain of loss can throw your mind off balance and force you to retreat from a clearly defined plan. When an unexpected red candle flashes on the screen, the experienced trader feels neither anger nor panic, but merely observes the fulfillment or non-fulfillment of conditions laid out long before the position was opened. This internal fortress is the only reliable asset that is immune to market volatility, acting as our strongest stop-loss.
The paradox is that true tranquility is only achieved when we willingly relinquish claims to universal dominion over external circumstances. We try to command the waves, although our boat can only meet them correctly, for the asset's price does not obey our desires or needs. The emperor constantly reminded himself, "What does not make me worse cannot make my life worse." And for the trader, this means that no loss, if it was within the risk framework, can stain his honor or spoil his method. Accordingly, our central task is to isolate the small circle where our will is sovereign, and to concentrate all our valor there.
Your greatest edge in trading is not strategy, but inner discipline. If you seek unbreakable calm amid market chaos, Marcus Aurelius's Meditations is the essential tool you need. This Stoic's journal will teach you how to separate emotion from fact, which is the foundation of an iron trading mind. Stop reacting, start acting rationally. The link to this key book, which grants you a mental edge, is in the description below this video. Most market participants, like blind hunters, chase the ephemeral external, forgetting the only internal goal that matters. They are captivated by a stock's 5% movement, hoping that this surge will last indefinitely. Or they suffer when their forecast is wrong, believing that the market has conspired against them personally. This is the essence of the illusion of control, the belief that we can tame the wild beast of volatility using only desire or aggressive intuition. We must embrace Heraclius's concept of panta rhei, that everything flows and nothing remains unchanged, including the price that currently seems favorable. Indeed, price is merely an instantaneous fixation of collective sentiment, not an objective truth, and its unrestrained flow is beyond the control of any individual decision. Anyone who has tried to catch the train or sit through a stop-loss knows how ruinous greed and fear are as advisors. When we allow ourselves to trade based on rumors or hot tips from the crowd, we hand over the steering wheel of our fate to external randomness. Realizing this fact frees us from the mental obligation to always be right, focusing instead on being disciplined.
Enlarging a position simply because everyone is talking about it is a manifestation of ochlocracy, blindly following the mob, where collective hysteria reigns instead of rationality, and this crowd is never right in the long term. The trader who sees a sharp drop and rushes to sell because they are afraid of being the last to exit is submitting to the lowest instincts, not to clear methodology. Wisdom requires refraining from trying to predict where others will run, focusing instead on where your own plan dictates you stand firm, like a rock in the storm. The illusion also lies in the belief that the amount of time spent on analysis correlates with the quality of the outcome, as if meticulous chart study guarantees success. In reality, the market remains an arena of probability, not determinism, and the deepest analysis can be refuted by one unexpected central bank decision. Marcus Aurelius argued that we should focus on the process, not the outcome, which always depends on 1,000 unknown variables. We sow the seeds of discipline, but we do not control the rain or sun that will bring the harvest.
If we do not control external movements, news, or the decisions of other investors, then what is our single zone of sovereignty? Our true battlefield is not the external screen, but the internal space where the decision is made. This is the only place where volatility cannot penetrate, where rumors do not rule, and where we can establish unshakable laws. It is here, in the clear distinction between the internal and the external, that the only effective weapon against fear, which distorts our perception of risk, lies.
Stoicism offers us the most powerful filter for mental chaos, the dichotomy of control, a strict and uncompromising separation between what is up to us and what is not up to us. In the world of trading, this division is the foundation of psychological resilience. The trader's control encompasses three fundamental elements: the plan, the risk, and the execution, and only within these parameters can we exert our will. Conversely, the uncontrollable includes the price, news, and the crowd, which are spheres of external randomness. We completely control our plan. We decide when to enter, based on what criteria, and how much capital to employ. This means that if we wrote that entry occurs only after a break above a certain level on volume, then no impulsive desire or feeling should change that rule. This is an intellectual agreement with ourselves, and violating this agreement is a direct act of self-sabotage. A true plan is not a flexible recommendation, but the constitution of our trading system.
Also absolutely under our control is risk, which in the market materializes through a single critically important tool, the stop loss. We decide what the maximum acceptable loss in monetary terms will be before the trade is opened, thereby removing the emotional reaction to price movement from the equation. This pre-established limit is the physical manifestation of Stoic wisdom, knowing the boundaries of our patience and financial endurance. The stop loss is the only thing we control in the price dynamic. Finally, we control the execution of the plan, which is the most difficult, as it requires constant internal vigilance against our own weakness. This means pressing the buy button when all plan conditions have been met, and, more importantly, pressing the sell button, stop loss, when plan conditions have been violated, regardless of hope or fear. This is an act of pure will, where the trader acts as a machine programmed for discipline, not as an emotional being. All external factors, price, news, and the crowd, act in accordance with the universal logos, the world reason that is too vast for our intervention. It is futile to fight macroeconomic trends or try to convince millions of other traders of our correctness. Accepting that the price may go against us is not a defeat, but merely a statement of the fact that the external operates according to its own laws. Our task is only to adapt reasonably to this law, using internal mechanisms of control.
Every second in trading is a test of our prohairesis, our capacity to make the morally correct choice, separating objective reality from subjective desires. We can control how we interpret a loss, either as a personal defeat or as the ordinary cost of doing business in the realm of probability. If the plan requires an exit, but the hand reaches to close the position for a 1% profit instead of the planned 3%, we are choosing immediate gratification, fear of losing what is already gained, over fidelity to our own strategy, thus undermining our internal citadel. Discipline is the trader's only virtue, for it replaces an irrational reaction with a rational response. When we see the market rapidly moving in our favor, there is an impulse to violate the plan and add more to the position than risk management allows, under the influence of euphoria. The Stoic understands that this is a mental trap. Any decision made under the influence of a strong emotion is always erroneous, as emotion clouds strict calculation.
Fidelity to the method is the highest form of internal freedom, as it frees us from the necessity of constantly making difficult decisions under pressure. We do not have to reevaluate every time whether we should adhere to the stop. It was already decided for us at the planning stage. This is like a soldier who does not argue with the order when the signal for retreat sounds. Because of this, internal energy is not spent on mental struggle, but is directed towards clear execution. True Apatheia, or stable tranquility, cannot be achieved through large profits, as they are external and transient, but only through the flawless adherence to one's own code. When you end the day, despite a loss, with pride in the fact that you never deviated from the plan, you gain a victory over yourself that is more valuable than any profit. This tranquility is a constant reward, regardless of the market's will.
That is why keeping a trading journal is not just accounting, but a daily philosophical practice of self-analysis. When we record our emotional triggers alongside actual execution, we reveal where our will faltered and where we allowed the external to penetrate the internal sphere. This allows us to recognize the insidious nature of fear or greed next time, before they overcome reason. The journal becomes a mirror of our soul as a trader, showing whether we were true to ourselves. The true Stoic trader understands that their task is not to win every trade, but to make every trade perfectly executed. If you entered according to the rules, set the stop-loss according to the rules, and exited according to the rules, the result is merely statistical noise that should not elicit an emotional response. This fixation on the process, not the result, is the key to liberation from the fear of loss.
When the inevitable period of drawdowns comes and losses follow one after another, our mind tends to rebel, demanding immediate compensation. But this is where amor fati, love of fate, acceptance of what happens, must manifest. The trader must not just endure the loss, but embrace it as a necessary element of the system. For without losses, the trading of probabilities cannot exist. If we try to take revenge on the market after a series of losses, we succumb to the illusion that we can change the past or force the future to obey. When a red candle of -3% appears unexpectedly, and the desire to make it back with a larger volume or open a position on another asset without proper analysis arises in the head, this is the purest manifestation of emotional reactivity that destroys capital. Such revenge trading turns us from rational strategists into dependent gamblers seeking quick gratification. The Stoic response is to close the computer and return to the plan only after a complete restoration of emotional balance, acknowledging this loss as a closed chapter. Drawdowns are merely a natural phenomenon, a cycle, like winter after autumn, and attempting to stop this cycle is madness, akin to fighting gravity. Instead, we should use drawdowns as an indicator that the current market regime may require less risk or a temporary pause. The wise trader does not blame the market, but analyzes whether their method is suitable for the current conditions, and if so, patiently waits for the statistical edge to return. The strongest weapon against the fear of loss is premeditatio malorum, the prior contemplation of adversity, i.e., imagining the worst-case scenario beforehand. Before opening a position, we must clearly visualize how the stop-loss triggers and how we will feel at that moment, so that this event does not catch us by surprise. This is not a call to pessimism, but a mental inoculation that reduces the shock of the actual loss, because we have already accepted it on a cognitive level. It is this prior acceptance of the loss that kills fear, because if you have already agreed to the maximum loss you can sustain, you have effectively already paid the emotional price for that trade. When the stop-loss triggers, it is not a catastrophe, but merely the confirmation of a previously established limit. The trader who practices this mental preparation trades without pressure, because they have insured their mind against unexpected pain. Loss is simply information, a neutral event that has no moral color and is not evidence of our incompetence. Our emotional suffering arises only from our internal judgment of this event as bad or unfair. If we objectively assess that the stop-loss fulfilled its function of protecting capital according to the plan, then we should thank it, not be angry, for it proved faithful to our discipline. The stop-loss is the philosophical stone of trading, for it is the materialization of the only thing we can fully control, the size of our vulnerability. It is not just a protective order, it is a manifesto of our will that sets the boundary between rationality and the market chaos we cannot tame. Its presence ensures that our mistakes will always be limited, and we can return to the fight the next day without being destroyed by one fatal blow. Stoics called external events adiaphora, things indifferent to our internal well-being, and price movement is the ideal adiaphora. If a stock drops 10%, It does not make us bad traders if we exited earlier according to the plan, and it does not make us great geniuses if we guess the direction. The stop-loss forces us to treat external movements precisely as indifferent, recording the loss as an objective fact, not as an emotional trauma.
The greatest danger arises not when the market moves against us, but when we emotionally stick to a trade, refusing to accept defeat. When the stop-loss has triggered, we must immediately let go of that trade and not allow it to occupy our mind. The fight is not with the price, but with our own ego, which strives to prove itself right. This mental cleansing is critical so as not to carry negative energy into the next, potentially winning trade. The trader's freedom, paradoxically, arises from voluntary limitation. We are free from the tyranny of fear only because we defined our limits in advance. Conversely, the trader who does not set a stop-loss, attempting to control the price, actually becomes its slave, for they are forced to constantly monitor every change in the quotes. The Stoic emperor understood that self-limitation is the path to internal sovereignty.
The stop-loss in the Stoic sense is a mechanism of oikeiosis, that is, self-preservation and the appropriation of what is truly ours. It protects not only our capital, but also our most valuable asset, the ability to think rationally. When capital is protected, we can think clearly, and when we think clearly, we make better decisions, thus entering a positive cycle of discipline. Protecting capital is the first duty to oneself as a rational being. Every stop-loss that triggers is not a tragedy, but a strict yet fair reminder of the necessity to adhere to the rule that we ourselves prescribed. This mechanism is the last bastion that separates us from irrational loss, and we should treat it with respect and gratitude. One should not wage war with an order designed to protect us.
Thus, the only thing we control in the stock market is our decision of how much we are willing to lose before accepting that our initial hypothesis was wrong. By making this decision before trading begins, we cut off the emotions that will inevitably arise when money is at stake. This advance action, this act of sovereignty over our own risk, is the deepest lesson that the philosophy of trading can offer.
We see that success in the market is not a function of predicting the future or lucky intuition, but a direct consequence of internal consistency and discipline. The true transition from novice trader to Stoic trader occurs when the focus shifts from anticipating price movement to the impeccable adherence to one's own operational manual. When we stop striving for control over the uncontrollable, price, news, we gain full control over what truly matters: plan, risk, execution. Fear dies where a clearly defined loss limit begins. Accept the fact that the stop-loss is not evidence of defeat, but a reliable guarantee of survival in the long term, and its activation is simply the completion of the trade according to the plan. Marcus Aurelius taught us that the obstacle on the path becomes the path, and a loss must be accepted as payment for an important lesson. Do not allow the emotions of one bad day to dictate the rules of the next, maintaining internal tranquility regardless of external chaos.
To solidify this Stoic lesson, here is your task for tomorrow, requiring the practical application of philosophy. First, perform premeditatio malorum, detailing 3 scenarios where your stop-loss triggers, and state your ideal, unemotional reaction to each. Second, write down your main risk management rule, one rule that cannot be broken, and one emotional trigger that causes you to break this rule, aka saw a red candle and wanted revenge. This awareness is your first step toward invincibility.